Hello everyone. So we did keep some people in the room. Thanks for staying. I promise I'll be short. So indeed, I'm not Jean-Jacques. Actually, I was sitting, I think, in front of the same audience 3 years ago, replacing Jean-Jacques once again due to an act of God. Actually, his son Alexandre last time had a flu, and this time he had broken his hands, and he has to bring him to the hospital today. He's preparing for the French Olympics. So unfortunately, Jean-Jacques couldn't be here. Nevertheless, so I work with Jean-Jacques. We work together on establishing Amundi Impact franchise, and more broadly, our sustainable finance strategy product range. And of course, I was there 3 years ago replacing Jean-Jacques, but I will not tell the same story nor the same speech. Why? Because the world has changed dramatically, also in the world of impact finance. So this story does not completely repeat itself, and that's fortunate. In today's speech, I'll cover broadly 3 topics or 3 sections. Number 1, doing a bit of a summary on our take on the state of the market, to really reflect together on what has happened, not over the past 10 to 15 years, but more precisely in 2023, which is the so-called setback, to reflect a bit on what impact finance can bring. And in the second section, I will reflect on what asset manager could do or should do to support positive real-world outcome. 2 hints here. Number 1, it's not an either-or proposition, it's a combination of flavors that one should activate. Second, it really stands or is supported by a need for great clarification, on which I will come back. In the last section, if we have time, I will illustrate my point, focusing on biodiversity and climate. So state of the market, as you all know, the past 2 decades or so have been a great, not necessarily smooth ride for sustainable finance, especially since 2015. It's been supported by strong tailwinds, which to a certain extent are unfortunate, because the number 1 tailwind for sustainable and impact finance is, of course, the major environmental and climate-related issues that are prompted by a global economy that is constantly testing and trespassing many of our planet boundaries. That is triggering more and more stringent regulations and, of course, significant investment program needs. Second tailwinds, targeted policy intervention focused on the financial sector to support transition planning across sectors and transition financing. So do mark my word, our position is that the EU Sustainable Finance Package has actually had a positive impact on sustainable finance development. Yes, we have to improve it, but it has played a critically positive role. Third tailwind, the strong societal support that we have all witnessed, with increased responsible commitments from the private sectors, including from asset owners, I hope there are some in the room, and from savers. But of course, like in any good growth story, it hasn't come without excesses and its fair share of overstatement. Like stating that you are very advanced in integrating extra-financial criteria in your investment process, communicating on related AUM, without actually integrating these criteria in your investment process. So that is harming trust. Like spreading the belief that portfolio tilting equates to real-world impact. That is not the case. Or that in the finance industry, unlike in any other sectors in the world, sustainability practices would come at no additional cost or trade-off. That is not the case as well. So perhaps that, to summarize, finance could be an agent of change without changing. That is not the case. This miscommunication has led to a year of perceived setback that we went through in 2023, largely echoed by Voice of Wall Street wannabe and politically minded editorialists. So we're gathered here today together doers, early movers in the impact space to discuss new projects and developments. But are these projects doomed to remain long shot because of this setback? Well, we believe the answer is no, of course. Let's look a few minutes at fact. In terms of fund flows in 2023, it's been a very, very strong year in a year of overall negative outflow. Very, very significant negative outflows for the entire fund industry in the vicinity of minus 80 billion. But if you look at the most advanced part of the market, advanced solution leaning towards impact, including impact but not only, it's been plus 30 billion euros of positive flows in a year of minus 80 billion. That's really, really, really significant. Looking at performance, ESG version of index, yes, that does not equate to impact, but this is something investors do look at. We resumed overperformance, going back in positive territory over the past 10 years. So yes, RI funds, impact strategies are subject to cycle, they entail biases, and are not immune to energy crisis, but what a surprise. What really matters here is the long run. Other factor to consider in a year where a few corporate and investors backtracking made the headlines, including oil and gas company, formerly headquartered not too far from here. Actually, the number of companies with an SBTi target increased by 67% in 2023, with significant traction in small caps, in emerging markets, in China as well. We also witnessed increased momentum in recognition of ESG materiality and demand from retail savers. That's really shown in the polls. Let me quote two polls. Number one from Morningstar. 67% institutional investors more convinced than before about the materiality of ESG factor. Second poll, 77% of individual savers declaring an interest in sustainable investing, 54% anticipating an increase in their sustainable investment over the next year. So what is my view for the future of sustainable finance? Significant traction, building on stronger foundation. But we need to work on establishing this stronger foundation. They will come from industry-led initiatives and regulatory push for greater transparency at product level, clarification on the commitments at the level of management company and the specific value proposition of investment product. And sometimes you have to explain the potential inconsistency or lack of alignment. But more importantly, it will come from better definition or understanding that ESG integration is not equivalent to responsible investing, and that sustainable investing or responsible investing is not equivalent to impact finance. So to summarize, we expect continued trend away from basic ESG integration towards more intensive sustainable value proposition, more ambitious ones, but this will come only in a world where everyone agrees on the definition I've just highlighted. Actually, I did not define the term, I just said that they were not the same. So perhaps let's have a closer look at this definition, using perhaps the PRI and the GIN. ESG integration, that's the process of including ESG factors in investment analysis and decision to better manage risk and improve returns. Responsible investing, we do consider these ESG factors when making investment decisions, when influencing companies, but with a view to support positive, real-world outcome. Third definition, impact investing, you all know it, so I will not dwell too long on that. But of course, investment made with the intention to generate a positive, measurable social or environmental impact alongside financial returns. We need to be very clear on these three definitions and really be very clear on the fact that each and every product bucket is not equivalent to the other. We need to be very clear about the value proposition. But we can use the different levels, actually. They all have a role to play. If you take Amundi as an example, we integrate ESG across the board with a double materiality lens for all our products. And we believe this is playing a positive role. We do it across all our open-ended funds. We do it in the way we vote, in the way we engage. We apply our responsible engagement and voting commitment systematically, thus voting in favor of 88% of climate-related shareholder resolution, 83% of shareholder related to social consideration. If we want to build together a stakeholder capitalism, a long-term capitalism, companies need to be backed by responsible shareholders with a long-term view. On impact investing in particular, we have set an ambitious goal to increase allocation towards impact funds as part of our plan, 2025 plan, to reach 20 billion by 2025, not making the mistake to confuse our responsible investment range with what we do in the impact space. It's a challenge, especially when it comes to emerging markets. At the end of last year, we reached 13 billion. We have a healthy pipeline. We'll do whatever it takes to reach the 20 billion. But yes, it's a challenge, like for any other impact investors. Another conviction of Amundi is that to bring credible answers to the massive challenges we are facing, so we should not be looking at either or type of answers, but we should activate the three levels I've described. So integration, responsibility, and impact. Let me show you how this can be done on biodiversity, natural capital as a whole, and on climate. Biodiversity. Why does it matter for a large asset managers like ourselves? Well, I'm sure you've been pitched a lot of impact solutions related to regenerative agriculture or to biodiversity impact today, so I will be quite quick on the context. But yes, it is essential for the well-being of our societies, and a healthy economic system provides fundamental life support functions. It's about food security, it's about health, it's about economic activities dependent on biodiversity, with potentially 44 trillion USD of economic value generation, so over half of the world GDP, dependent on biodiversity. On the other hand, we have agricultural and the agro-food sector that fulfill one of the most critical functions of our economy. It feeds us, basically. But it is also responsible for 33% of global GHG emission, while amounting to 9% of GDP and 7% of the workforce. Safeguarding the ecosystem requires massive financing. And Europe's agri-food industry alone needs between 20 billion and 46 billion of additional funding. So what have we been doing using the different levels I've outlined to contribute tackling these challenges? As a responsible investor, we've been integrating biodiversity-related factors in our portfolio management with a double materiality lens. Biodiversity loss represents a significant risk to a certain number of business performances. We're talking about trillions in gross value added impacted by new regulation. As long-term investor, we have to be aware of this potential risk. We need to make sure the companies in which we invest are addressing this risk, be they based in France or in Brazil and across emerging markets and developing economies. We need to be aware or make sure our investing companies are aware of evolving consumer practices. They will also be critical. The greatest risk to the fast fashion industry is that it falls out of fashion. We need to be pricing this long-term risk. We are also acting as a responsible steward of the company. So I'm moving from the standard ESG with a double materiality lens to responsible investing. What do we do as a responsible investor? Well, natural capital preservation is one of our 5 overarching themes on which we engage. We engage on biodiversity preservation as a specific topic and on the direct drivers of biodiversity loss that are linked to other planet boundaries. We started this work in 2021 with a sample of 52 companies, with the view of identifying best practices across sectors and geographies, and use these best practices to engage further companies with clear guidance on what could be done. Last year, we increased that number to 300 companies. We also expanded our efforts on biodiversity as part of the establishment of our biodiversity policy, covering deforestation, water usage, deep sea mining, pesticide use, among others. Trespassing the thresholds that we've set vis-à-vis this business involvement triggers a specific engagement with clear escalation. We can vote against the discharge of directors if everything goes wrong, if we don't see the right reaction function, and of course we will vote accordingly on other shareholder resolutions and resolutions submitted by the board. To measure corporate biodiversity impact across the board, we've supported the emergence of new norms, new standards in the form of MSA, which is used increasingly by a high number of companies and financial institutions to measure biodiversity footprint and tomorrow control it and lower it. So there is a role to play for ESG investing, a role to play for responsible players, but of course there is a role to play for impact investor. As an impact investor, we developed an impact strategy, Agri-Agro Direct Lending, that we presented over the past 2 days, with a target program size of 750 million euros, dedicated to financing the transition of the agriculture and agri-food sectors in Europe towards more sustainable models. We know in France, we know in the Netherlands, that this is a challenge. Farmers are facing a massive challenge. They're aware of the matter. They are more and more cognizant of the tools they have at their disposal, but very often they lack access to the right kind of financing, notably in the current context of interest rates. This fund aims to address that situation. 2 pillars of the strategy: lowering the overall carbon footprint, but also working together on limiting the overall environmental footprint and identifying the levels available to have a positive impact. So really seeking additionality. So natural capital, if you see through this example, can be addressed through proper ESG analysis with a double materiality lens. Of course, it's not enough, but it does contribute to a realization of the issue of pricing of risk. We need to act as well as responsible investor. That is not the same, because we do take into account this materiality analysis in a way we engage companies, and we need as well to develop more impact strategy targeting direct real-world impact or through investee companies and investee projects. Actually, we do the same on climate. It's another planet boundaries which has not yet been completely addressed, or not addressed at all, some would say, by policies, by investment programs, and this needs to be addressed through the different levels I've just outlined. That is the reason why we want to enhance, if you want, the analytics that we use across the board for our portfolios, notably in terms of systematic climate stress testing use. That's the ESG approach. We want to engage systematically companies on their net zero trajectory with very clear escalation measures, and we do vote against, again, the discharge of the board or the chair if companies are not doing the right thing. And we need more and more impact strategies, notably to provide financing in the areas that are in desperate need of energy transition financing. That is the case, of course, in some parts of Europe, but that is even more the case across emerging markets and developing economies. We try to do so as well through the development of sustainable capital market across the board. Why? Because we believe that impact finance directly targeting real assets investment can reach a certain scale, but you need to activate the full value chain of capital markets to reach the scale we need to address the global challenges that we face. That is true for biodiversity, that is true for climate. You need to have leading banks on the ground. You need to have local investors able to take local currency risk, which is not a risk for them, obviously, and so on and so forth. So that is the reason why we are really trying to activate all the different action we can take, the different levels we have at the different level. And the beauty is that through that approach, you can really always have a client-centered approach, providing the right answer to his or her needs with the right investment solution. But once again, and I'll conclude on that, this requires really to be very, very clear on the value proposition. ESG investing, responsible investment, and impact finance. Thank you all.